The reason for today's video is because of this. I was browsing through Seeking Alpha and I saw this notification where there are 106 consumer discretionary stocks whose dividends are at risk. So I thought it would be great if I could share a bit on how I evaluate the dividend safety of the stocks in my portfolio. I've been making YouTube shorts analyzing the dividend safety of companies, and those are basically the things I look at. But in this video, I would like to go in depth and demonstrate how I go through the process of determining the dividend safety of the stock. But before I do that, I would like to disclose my portfolio to the audience. As you can see, I have two different portfolios, one of which is my personal portfolio that I buy from my bank, and another is on eToro because I can't buy UK stocks from my bank, so I need to use eToro to buy them. That being said, this is not my first time investing. I've been in the markets since 2019 using eToro. I've traded, played around with risky tech stocks, played with a bit of crypto, those sorts. And in 2023, I have decided to start settling down and to build a portfolio that not only provides me with a stable dividend income, but also gives me enough capital gains to grow my wealth steadily. As part of my 2023 resolution, I want to build a dividend income of $120 a year. Currently, I'm about 30% there, and I would love to achieve this goal by the end of the year. As you can see, my portfolio so far consists of 5 stocks: Church & Dwight, Unilever, Dow, Rakuten, and GSK, all of which are blue chip stocks that pays steady dividends. I am up 3.59% on my personal portfolio and up 0.51% on my eToro account for the year, which is a good start. Now, before getting into the main topic, I would first like to go through a case study of what happened to a stock in Malaysia that is an excellent example of what is not a safe dividend stock. The company in question is called Hubsing Industries. Hubsing is a biscuit manufacturing company that produces biscuit brands that are beloved by Malaysian households. When I was younger, I would eat these biscuits before I go to school. It is practically a Malaysian staple at this point. As you can see on the surface, the company pays out nice dividends to their shareholders. From 2015 to 2020, the company has paid dividends of 6 cents a share to shareholders. However, in 2021, something went wrong. Their dividends were cut to 2.5 cents a share, and they cut it even further to only 2 cents a share in 2022. But why? As we can see here, their net profits have been declining every single year since 2015, but their dividends have remained stable up until 2020. This was reflected by their ever-increasing payout ratio until it was at an unsustainable 160%. As a result of this, their dividends were cut, and due to the poor performance, the stock has been punished severely. The beloved household brand has seen its stock slashed by more than half since its peak in 2015. Imagine if you were a shareholder in this company in 2015. Not only would you have gotten your dividend income severely reduced, you would have lost half your capital as well. Therefore, it is extremely important that investors like us know how to judge the dividend safety of a stock. The first criteria I look for is revenue growth. It is crucial that a company can grow its revenue so that it can continue growing and sustain its dividend payments. Using Procter & Gamble as an example, we can see that the company does indeed have growing revenues, as it grew sales from 70.9 billion in 2020 to 80.2 billion in 2022. For a more accurate analysis, I would typically look at a 5-year track record, but for the purpose of this video, we'll just look at 3 years. Procter & Gamble's revenue growth gets a check. The second criteria I look at is whether there's net income growth in the company. The net income is basically the profits that the company makes, and if their net income isn't growing, their dividends probably won't be supported as well. Therefore, I would like to see growing net income for the company. As you can see for Procter & Gamble, they grew their net income at a compounded annual growth rate of 6.38% since 2020. The reason why this growth rate is important is because you want to make sure that net income growth exceeds or is in line with dividend growth. Otherwise, the dividend payments will be at risk when it eventually catches up to net income. The last criteria I look at is the dividend payout ratio. The dividend payout ratio is basically the percentage of profits that the company pays to shareholders as dividends. It is actually very easy to calculate this. We first need to take two numbers, net income and dividends paid. Once we have these numbers, we basically divide dividends paid by net profits and multiply it by 100% to get the payout ratio. As we can see here, Procter & Gamble's payout ratio is 59.49%, meaning they paid 59.49% of their profits to shareholders as dividends in 2022. Well, based on this logic, the lower the dividend payout ratio, the better, right? This is true in general, but it really depends on the industry that the company is operating in. For example, it is acceptable for tobacco companies to have high dividend payout ratios because these businesses simply have no way to reinvest their cash that can lead to higher business growth. But the tobacco industry is a highly lucrative industry that generates lots of profits. Since there's no way that the company can deploy their cash, it is better off being paid to shareholders as dividends. Conversely, for tech companies, having a high dividend payout ratio is usually frowned upon. This is because these businesses still have a lot of growth in front of them, and investors think that the cash can be deployed more effectively to fuel growth for the business. Ultimately, it depends on whether the company can effectively deploy capital with the cash that they earn from their operations. If so, then the dividend payout ratio should be lower. If not, having a higher dividend payout ratio should not be too big of an issue. To summarize, the three things I look for when looking for a dividend stock is 1. Revenue growth, 2. Net income growth, and 3. The dividend payout ratio. Hopefully this video helps you examine the dividend safety of the dividend stocks that you are interested in buying or the stocks that you have in your portfolio. Happy investing, everyone!